answering your tough financial questions for the past 26 years. It's Allworth's Money Matters with co-hosts Scott Hanson and Pat McClain. Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hanson and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. I'm Scott Hanson.
I'm Pat McClain.
Glad to be here today as we're talking about financial matters. I should say post-election, but bizarre timing and bizarre outcome.
Well, I thought the best part about the fact that there was no civil unrest because
Not this week.
Yeah, but maybe by the time it happens, everyone has calmed down.
Yeah, by the way, we're recording this Thursday afternoon, so I seriously doubt anything major is going to happen on Friday. But what's been amazing is the financial markets. The previous week was an ugly week, worst week since March or April. The media likes to have these kind of headlines to shake people a little bit. And then this week, like the strongest week since April.
Again, you cannot time this market based upon headlines or any market based upon headlines.
Well, and it just shows you how resilient the markets can be. And investors want to believe and are believing in our future.
And that's
post-COVID.
That's what it says.
Post-Biden, Trump, whatever, right?
Yes. Post-Twitter, post-Facebook, post-everything.
And we all remember these jobs they're all temporary positions for these people, right? I mean, half of this, the House in 2 years we get a chance if we want to bring them back or send them home. And
yeah,
I mean, they're all temporary positions. It's anyway. I think.
Well, let's talk about money, though.
I think that's how we were tying the stuff into. But we will take calls today. And in the second half of the program, we've got Andy Stout, our Chief Investment Officer, join us, talking a little more in depth about the markets, our reactions to the elections, maybe what's happened to other periods of time during different administrations.
What is the statistical correlation between a Republican president and a Democratic president to the markets? It's But I'm looking forward to it. Andy he works out of our Cincinnati office.
There's some that would probably prefer the Democrats controlling the White House, the Senate, and the House. Others would say, I want the Republicans to be able to control all three.
I'm kind of a fan of gridlock.
I kind of am, too. I don't know if I want any new rules.
A little bit of a fan of gridlock.
At least it seems like that's the only time there's a little bit of checks and balances on some of our spending, and at least when the other...
Well, there hasn't been any checks and balances on spending in the last, couple years.
God, that's for sure. It's just bizarre.
It is something. It's just how much, it's just like a blank check.
I had coffee with a young gentleman a couple months back, outside, social distance.
The whole bit.
Masked up. I was wearing a full hazmat suit. I wasn't really, but he was 25 or 6 in financial services. I forget who he worked for. He's trying to get basically more into the fiduciary financial planning model. And he was excited about modern money theory. And I look at him like, you're kidding. He was surprised that I wasn't a proponent of this kind of new theory that you can keep printing money as much as you want and it's never going to have any impact, which is essentially this modern monetary theory. Isn't that what they call it? MMT, modern monetary theory.
And he liked it.
He was surprised that I wasn't, that I thought it was all garbage.
Well, someone's got to pay.
I just have never seen the history of a time in a society that's been able to print money for indefinitely.
Yeah, I mean, you can issue as many bonds as you want, much like, if I could get a credit card company to just continually give me money and tell them...
Forever.
Yeah, but you don't have to pay it off in 30 years, 40 years.
And it's forgiven at your death. Of course, you'd go into debt forever.
Yeah.
Anyway.
All right. If you'd like to join the show, if you have a financial question for us, give us a call at 833-99-WORTH. That's 833-99-6784.
And let's start off here in Cincinnati with Kurt. Kurt, you're with Allworth Money Matters.
Hello.
Hi, Kurt.
Hi. I have questions about annuities. Annuities. The situation is my mother would like to cash in some old annuities that she has, and then generously gives the money to her sons, me and my brother. These are annuities that were purchased back in, I think, 2008 with a lump sum, one-time purchase. They're non-qualified annuities.
And how much?
And
Go ahead.
Oh, what? And since then, they've been getting 3% interest every year since then. So they've grown. Oh gosh, I think about 130,000 of the current value. Current value of them is, I think, 320,000.
And she put in
130.
How much did she put in?
What did she start with? I calculated that she's earned $130,000 on both of them.
And how old is your mother?
She's 92.
Oh.
And why these annuities? Does she have any other assets that she could give to you if she wanted to, other than these annuities?
No, this is what she's got.
And what's your ballpark annual income, taxable income?
My income?
Hers.
Oh, hers. 36,000. It's pretty fixed. It's Social Security and I think a retirement kind of a pension that she has.
And is she still living on her own?
Yes.
And does she have any other assets?
She has a condominium that she owns outright. She has a automobile, and she does have one other annuity with about $30,000 in it.
Do you need the money, or does your brother need the money?
Brother does. I don't.
How does he need? And here's what we're trying to determine, right? So the challenge with annuities, the salespeople like to talk about how they're tax deferred growth. You don't have to pay tax on, but all that earnings will one day be taxed, and now that's what we're facing right now, right? And you're called like, how do we best structure this? So,
and it will be either taxed to your mother if she cashes them in now, surrenders them now, or it will be taxed to you and your brother when you inherit them.
But annuitizing might be the right way to go. But
it's 3%, which is the issue. Is you're not going to get 3% on a fixed.
I don't know what the guaranteed annuitization table is. This was issued 13 years ago.
Yeah,
But
I think another driving thing here is she wants to be very 50-50, and these annuities are not. One of them is worth a lot more than the other. Like, they're saying that she could give one annuity and just transfer the name to me on one of them, and then the other one to my brother. Then one would be getting more than the other.
But you can't, Pat. I'm trying. You can't. She's going to have to incur the interest on it. She can't just transfer that.
I thought.
Yes.
Yeah, I think she should just cash in. And I
wouldn't.
Okay.
So here's one way to spread out the taxation is to do what's called an annuitization of the contract, and this is where she tells the insurance company, look, keep my lump sum in exchange for a series of payments. Maybe it's over 3 years.
Maybe it's 5. Maybe it's 10. Years. How much money does your brother need? You said you don't need it. Does your brother really, really, really need the money?
Yeah, he really.
And how much does he need?
Yeah. Well, as much as he can get. He's barely scraping along. He was laid off from his job a couple of years ago.
Because one option is your mother just takes a withdrawal of some portion and gifts it to him. And
yes.
Because the challenge is the way the taxes work, right? So right now, her taxes are almost nothing. She's a little old lady, and her taxes are almost nothing. She takes $130,000 gain from an annuity. It's added on to that other income. Now she's $160,000 fat cat retiree and will be paying taxes as such.
Well, she's okay with that. She's thinking time is short for her. She's being told that her heart isn't good. she's not in great health. And I was looking at it thinking, okay, she's going to pay, that'll put her up in a tax bracket that ends, that goes up to $164,000. So I'm telling her, what if you take out almost all of it, or like take all from one, but leave some in the other, so you can pay the $30,000.
I would no way would
tax.
I do that.
Well,
I mean, if I do that, I would rather do a different strategy and take a stack of cash and light it on fire, because it's almost the same thing you're doing. The way the tax, she can withdraw some in 2020, and then wait till January and withdraw some more and spread it out over those 2 tax years, or take some out this year, some out in 21,
and
some out in 22.
What is your income?
Me?
Yeah.
I'm making like $125 a year. And my wife, she makes about 40, so we're
165.
We're at around 165.
And your brother's nothing.
So what happens is this money's going to be.
Yeah, he was making really good money. He was in the airline industry. Now he's barely scraping by, can barely make payments. Never saved a penny for long term. He's older than me. He has nothing. I have a lot in 401k. So he's looking at a pretty bleak future. So that's how he's always been.
So if your brother inherits this, he's going to be in a lower marginal tax rate than you
until he inherits the money, and then he's in a high tax bracket.
Unless she decides to do a 10-year payout on these with a 10-year payout, in which case the money comes over a 10-year period, and you name them as the beneficiaries today. Yes. And then your mother could do whatever she wants with the money that she receives.
If I were in your situation, I like your concept, Pat. I would say, Mom, here's what we're doing. You're going to annuitize these dollars in what's called either a period certain, like a certain number of years,
which would be a 10-year certain.
A 10-year. You wouldn't, if you're too short. What if a 10-year certain? What happens with that? Every check that she receives, a portion of it is a return of her own principal, and a portion is taxable. She can then gift your brother what his needs are. I mean, he doesn't need this much money all in 1 year. If he hasn't been responsible up until now, he's going to make poor choices with it. Seriously.
Well, that's what I'm telling her.
And then in 3 years from now, he'll be coming to you,
Scott. That's why I like this 10-year certain. So what you're going to elect is what's called a life and 10-year certain, which means if your mother lives to be 104, they will pay it out till she's 104.
She's 92.
Mm-hmm.
That's 12 years. I'm just showing off my math skills, Scott. Or at a minimum, they're going to pay for 10 years, regardless whether she lives a day or 8 years. By doing this, you're actually not driving her into a higher marginal tax rate. And you're putting some fiscal responsibility in this plan for your brother, so that at least he's got a guaranteed income as a beneficiary for 10 years if your mother passes away.
And she could if she gets a check, let's say it's $5,000 a month, whatever the number is, she can choose to say, I'm going to give $3,000 to each of you, or not, right? And then, because then her taxation is going to be very minimal if it's spread out like this. And if she passes away early, it's spread out for you for a few years. That's what. If she passed away today and you came to us and said, "Hey, how should we receive this?" Would say, "Kurt, don't receive it all in 1 year. It's too much tax on it. Let's take it out over the next. Let's do a 3-year payout or something like those lines."
All right.
So I would do do a 10-year payout. So when you call the insurance company, you're going to ask them. You're going to say, "We'd like to annuitize this. What are our annuitization options?" And then they will give you a list of options. You want to go with 10-year certain, whatever says 10-year certain, which means a life annuity only pays out to the annuitization. You do not want that. You want to get this paid out over 10 years. Your mother gets the money. She'll withhold taxes.
You can do 5 if you want, but it would drive you in higher taxes.
Yes. And then when your mother passes away, your brother and you would receive those stream of payments directly to you as the beneficiaries of the annuity. 50-50.
And my guess, Pat, is the annuitization tables that are guaranteed in the contract are at that 3% rate.
My guess is that they're pretty good. So that's how I'd manage it.
So another concern is the state that we live in. If she goes into a managed care facility, if she has to go in and starts paying out, and then runs out of assets, we believe the state starts paying, but first they make sure they've got
most
all
states
the
work
assets.
that way.
That's right. But there's a look back anyway. In most states, which means that if your mother gifted all of this today and then turned around and went on state aid, the state would look back 18 to 24 months, depending upon the state, and say, hey, that's funny business. We think you were trying to artificially impoverish yourself. Sure. Whereas if you annuitize them, you actually give up the principal for a stream of payments. And so they could put a lien against the estate, but only to the maximum of what that payment would be in most states. So that's why.
What do you mean?
So what happens is.
Max. What do you mean?
So what it means is if she's receiving $5,000 a month or $2,000 a month, they're going to take that as income if she goes in a long-term care facility. The annuitization, they may, depending upon the state you live in, claw back the rest of it. But this is the way that people artificially impoverish themselves.
And states do everything in their every state's different, but states do everything in their power. If someone's got assets and they need, it's like why should taxpayers pay if they've got the assets? Right? I mean that's
so. Kurt, when we were giving you the advice, I'm glad you brought it up. We were thinking about the same thing, which is what happens if she goes into a long-term care facility. And check that box. The annuitization is still the best.
Yeah. Appreciate the call. And I mean, if you really want to do this right, you'd actually run some numbers with an accountant
or a good financial advisor.
It's just pretty simple, kind of just.
Yeah. But what
no one knows what the tax rates are going to be 5-10 years from now, but
no.
You might make an argument that the 5-year or 7-year certain would work out just as well.
Yes.
But those clearly, if it were my mom, I would do an annuitization on that. There's no way I'd take a lump sum.
The reason I chose 10 years rather than 5 and 7 is because of the brother that has financial difficulty. He's going to spend it.
You know what's going to happen otherwise. It's going to be 10 years down the road. Well, the time mom's going to pass the condo, he's going to spend that. It'll be 10 years down the road, and he's going to come to his brother and say,
I'm out of money.
Can you help me? I need a little money for...
Yeah, but this way there's a payment for 10 years.
Yeah. All right, let's continue on with Allworth's Money Matters. 833-99-WORTH will get you on our program. If you've got a question for us regarding some financial matters you're dealing with, let's go to Colorado and speak with Mark. Mark, you're with Allworth's Money Matters.
Morning, guys. How are you?
Good, Mark.
Hey, question for you. I'm getting ready to where I can take early retirement next year. My income is only like $45,000. My thought is I would still keep working, but I could put in the max into my 401k, and that would keep me just under the $18,800 penalty and keep working, but I would be able to basically max out my 401k. Does that sound
I'm confused.
Something like...
I don't know, Pat, are you confused?
Yeah,
Okay.
but keep working. You said you're going to retire next year.
From where?
I worked for a company, and I could take early retirement, but my plan was to keep working. The deal is because I only make like $45,000.
Okay.
If I put in $26,000 to their 401k, that would keep me under that max where you could only make like $18,800.
I don't know where that $18,800. You're talking for Social Security.
Right.
Does it? Yeah, it doesn't work like that.
No, so you're talking about if you're thinking about how old are you today?
I'll be 62 next year.
Yeah,
okay, so you're thinking about, wait a minute, what if I retire early from what about if I start taking Social Security
while I'm working,
max out my 401k to get my taxable income way down, right?
Right.
The challenge is, if you go back and you look at your last year's W-2 from your employer, it will list out. You've got there's two different taxable numbers on there. There's your Social Security tax wage base, which is your entire salary. Then they subtract out the 401k, and then there's your federal and state tax,
which you pay taxes on. But the second number is not the first number. So I like your thinking. And someone at the Social Security Administration thought about this before, and it doesn't work like that. They're going to take your gross wages.
Okay. I thought when you
Yeah, I
money into
I
your
know you're right, but that's for
401k
taxes,
to-
but it's not your Social Security wage base.
Oh, okay. So Social Security wage base is different than your.
That's
Other
correct.
expenses.
Now, if you were self-employed and you had $26,000 worth of expenses and were able to, matter of fact, you might be now you'd have the pension issues. You'd have the same issue. But if you had other expenses that you can write off and bring your income down, then they're looking at what that net would be. But
Right.
No.
why do you want to start Social Security early?
Why do you want to retire early?
Well, the only reason I thought about doing that is if I did that, I would be able to get the max into my 401k and still basically I
Got
would
it.
come out making more money.
Oh, got it.
Yeah. Well, that's a good thought.
Nope. Good idea.
But no.
Yep.
Yeah, but no. So,
Nice,
All right, well,
nice
Thank you
try.
guys very much.
I
Nice try.
appreciate it.
Appreciate it.
Yeah.
That's-
Well, it's good to look at these things because every
Yeah.
once in a while you find little loopholes in various places. So let's continue with calls here. We're going to go to Sacramento and speak with Tina. Tina, you're with Allworth's Money Matters.
Hi. I have a question on Social Security.
Yes.
I'm 56, and I'm wondering if I don't ever work again, do I still qualify when I reach age?
Yeah, as long as you have 40 quarters of work, 10 years of work, you still qualify.
10 years? Oh, okay. Yeah, I definitely have like over 30 years. Okay.
Are you in a financial position where you can afford to retire and never have to worry about working again?
Well, I don't know that I won't ever work again, but right now I'm just taking some time to watch my grandbaby.
Oh, nice.
So I'm just taking some years off, and you just never know what's going to happen down the line. So I just curious about that.
It will be lower.
But maybe not that substantially. The Social Security is very progressive in the fact, let's say you only earn $10,000 a year in your working career history. My guess is you were earning more than $10,000 a year. Social Security is going to replace about 85% of that, of your wages. So almost all of it, Social Security. But the higher you go in your wages, you're still paying the same amount into Social Security, but it replaces a smaller and smaller percentage of your paycheck. So I'm trying to forget what the maximum amount, whatever. Let's say that you qualify now for $2,000 a month. Perhaps
Correct.
it would be $1,900 a month if you didn't.
And you
contribute
can
between
actually
now.
play with those numbers if you go to the Social Security website and you can put what your expected wages will be in the future. It will actually calculate it, assuming that there's no change in Social Security law, which there will be.
Right. I know. That's always a factor.
There will be. Quite frankly,
But you-
it's hard for me to believe that they still pay out early at 62. Quite frankly, I don't quite understand why they do it, but they do.
So are you saying that the amount could go down?
Oh, most certainly will go down. The question is how much
so you
will it
receive
go
a
down?
projection every year, and it's based on you continuing to work until your retirement date.
Oh, see, that was my second question. It's based on me like keeping my salary.
That's right.
That I had.
That's what the projection is. Yes.
Yeah. But you can actually you can play with that projection if you're interested and put in zeros from now until age 62.
Tina, are you single or married?
Single.
What might be helpful for you, and not what wouldn't? What would I highly confident would be helpful for you to meet with a good advisor and do a kind of retirement plan for yourself, right? Because I think it's wonderful you're taking this time. You're not going to be able to repeat this season of being with your young granddaughter, right? So I think that's phenomenal, and perhaps you can totally afford to do this and still have a great retirement in the future. There might be some adjustments, but I think the more clarity you can have there, the more peace you'd have about it all, and the more confidence you'd have in your future. Because otherwise, there's no sense
you don't want to get to 62 and realize that you made a mistake when you were 57.
Or every day regretting, like feeling guilty about doing this, thinking you're jeopardizing your future when you're not.
Right.
So that's why you're asking a specific question, and our question is, can you really afford not to go back to work?
Right. No, and I've thought about that too.
And if you're saying, look, this is really important to me, I need this season, great. Then what's our plan to make sure that Tina is going to be in a financial position in the event that one day she cannot work, to make sure you've got income coming in?
Mm-hmm. Yeah.
What are you living on now?
I've got a big severance, and then I have a rental house I'm selling. So
you would definitely, you'd definitely be.
Yeah.
I would. Is it going to be closed this year?
yes.
So you've got severance, taxable severance, and income from a sale coming in this year.
Well, I'm actually deferring the sale probably till next year for tax reasons. Yeah.
Thank you.
Till January.
And so does the rental property generate any income?
Well, not right now. I'm fixing it up right now.
Okay.
It
All
was,
right.
but
Well,
So you're finding a way to have cash flow now. I think our concern is you're 56 today. What about when you're 66, 76, 86, or 96? Right? I mean, that's. So I think meeting with a financial advisor and having a good retirement plan would make some sense. We're taking a quick break. You're listening to Allworth's Money Matters with Scott Hansen and Pat McClain.
Can't get enough of Allworth's Money Matters? Visit allworthfinancial.com/radio to listen to the Money Matters podcast.
Welcome back to Allworth's Money Matters. Scott Hansen,
Pat McClain,
talking about financial matters, and we've got Andy Stout going to be joining us here in just a few moments. He's our Chief Investment Officer. I want to talk about kind of his perspective on the markets and whatnot. But before we do, we had a previous caller. Our previous two callers were asking about Social Security.
Some questions around Social Security.
And if you've listened to our program for any length of time, you'll know some of our thoughts on Social Security, which is essentially in planning for your retirement, it would be best if you can plan that you will not receive Social Security. It'd be great to be in a financial position where you're financially independent and don't need Social Security. Obviously, that's a luxury that many people are not going to ever get to. But if Social Security is going to be, you will be reliant upon some Social Security for your retirement in the future. The question is, how much should you be banking on? Should you be banking on everything that's in the projection today? Because before this pandemic, Social Security was already in trouble. It looked like they were going to run out of money in 2034. Now, the latest that we've seen, this was an article just in the New York Times in the last week or so. Now we're looking at maybe 10 or 11 years when we are
out of money.
The Social Security, it's out of money.
What will happen there?
There's an automatic cut.
Yeah, they won't do an automatic cut, in my opinion. I know legislation, the rules say that they will do an automatic cut, but they're not going to go to someone who has receiving $12,000 a year and this is all of their income, which, by the way, it's estimated that 40% of the retired population lives solely on Social Security benefits, 40 to 50%. What they'll end up doing is saying, much like how they collect the benefits for Social Security, they'll say, okay, income's over 100,000, you take
whatever.
the cuts. Income's over 50,000, you take part of the cuts. Income's below 50,000, you can continue on 100% of the benefit.
Well, so the Social Security, the Congressional Budget Office report this last September predicted the trust fund would run out in 2031. But others, including the Bipartisan Policy Center, project it could be sooner than that.
Bipartisan Policy Center, that's kind of an oxymoron.
This is pretty amazing. 25% of elderly households rely on Social Security for at least 90% of their income.
Yes.
And the majority of retirees, Social Security is the majority of their income.
That's right.
Those people, I don't think...
The government, they can't. They can't. If they cut that, they can't.
So it's going to have to be made up somewhere. There's no extra for those families.
That's right.
There's nowhere for them to cut.
You can't take a large population of 70-year-olds and make them homeless.
Which is essentially what would be happening because they're not huge checks for most of these people.
Yes. And so this sticks with our theory, if you've listened to our show at all over the last 25 years. If you don't need Social Security, if you don't need it to retire, then delay it as long as you can.
It's funny. This article talked about Biden.
If you don't need money for retirement, Social Security, you take it as soon as you can. If you need it, you delay it as long as you can.
If you need it, you delay it as long as you can.
If you need it for your sustenance in retirement. If you think that you could do without, you should take it early. Why do you take it early? Well, because if you don't need it, you're most likely to be the ones that they actually stop sending the check to.
You know what's fun, or reduce it somehow. It's funny. Years ago, I would argue with people. People would have arguments with me because I write every other week for Investment News, an industry periodical, and I write for some other things every once in a while. And I've written about this, and I'll get some flack for some other people. I used to.
About how that's not the rules?
This was maybe 10 years ago. I wrote an article where I compared it to the same way an analyst would judge the value of a bond.
What's the likelihood of getting paid?
What's the likelihood of getting paid? You would start that with any sort of future income stream. What is the likelihood? Is there any potential for any degradation of that income stream 5 years, 10 years, 20 years, 30 years? Of course you would. You'd go through that. And if any rational person, how could you couldn't say that, 30 years from now, that Social Security is 100% guaranteed just because
the government said so now.
Of course not.
Yeah. They put the policies in place. They can change the policies.
And they have over the years.
Yes.
Anyway, enough about that topic because here at Allworth's Money Matters.
Which reminds me, a little side. I was returning something to Home Depot, a broken...
What's this? Okay.
I was just telling about policies. I was returning a gas blower to Home Depot because it was broken. It was less than a year old. And
you don't get the electric ones, the battery charged ones? I'm part of the green team. See, I care about the environment. I'm too cheap.
I actually have both.
I just don't want cans of gas in my garage.
I go to return it, and they said, well, it's been used, and it's more than 3 months old. You can't return it. And they said, that's our policy. And I said to them, well, my policy is that I can return it. And they said, where did you get your policy? I said, I got my policy the same place you got your policy.
Made it up.
I just made it up.
And did they return it?
They did take it back.
They did?
Yes. They were very nice about it. Once I explained my policy about buying things that don't work, that I get to return them. They did bring the manager of the store, and he asked the same question. He told me his policy, and I told him my policy. And he said...
They just don't want to have to deal with it.
Well, I told him what I was going to do. I said, I'm going to go back to that store. I'm going to buy a brand new one of those. I'm going to take my old one, put it in the box, and return it so that it looks like I bought it yesterday.
You probably wouldn't have done that, but that's what you were...
Yeah, maybe not. But I almost went there. Policy. But they changed policies. They're going to change policies with Social Security. You can bet on it.
They have to. I mean, Biden had a plan. It doesn't really matter now because, well, as of Thursday afternoon when we're recording this, we don't know who the president's going to be. But assuming it's Biden, there's a Republican-controlled Senate.
Yeah.
There's not going to get any. There's not going to be any major changes. So I don't know what's going to happen the next 2 years, frankly.
No. Anyway, back to Andy Stout.
Yeah, so Andy Stout is joining us to be part of the program. Andy Stout is our Chief Investment Officer of Allworth, and he's been on the program a couple times in the past, and you've probably heard him before. And so anyway, Andy, thanks for taking some time to join us today.
Thank you, Scott. Thank you, Pat. Happy to be here.
So as of this moment, and I seriously doubt by the time this is broadcast on Saturday, we'll have a declared winner. From an investment standpoint, as the chief investment officer of almost $10 billion that we manage for 13,000+ clients, how concerned are you about the outcome of the election?
Not really that concerned. I think you hit on the major point just a second ago in that we're going to have a split government either way you look at it. So Republicans will control the Senate, Democrats will control the House, and the president, it looks like it's going to be Biden, but there could be some challenges along the way. We could see a delay of game from the Trump administration currently, but we're going to see a split government. But even if we didn't, and I see this so often where people get so caught up in the politics, and you're so worried that the wrong party, whichever side of the aisle you're on, but the wrong party wins, the worst case scenario will play out. You know how many times the worst case scenario is played out? 0. So
I think people's like, oh, no, it's going to be Bernie Sanders policies in place. It's going to just be a train wreck for our economy. Or
I was speaking to a neighbor of mine who happens to be a client this week, and he said, is it the phone been ringing off the hook from clients because of the election? I said, no, but it will once it's determined. And he said, why? I said, because it always does, whether it's a Republican or Democrat wins the presidency. There is a constituent of our clients that are opposed to that, and they believe that the financial markets will reflect their beliefs, and that the markets are going to go to. But there's no statistical evidence that says that. Is that correct, Andy?
No, you're absolutely right. I mean, if you pull out your money and look at it, is it red? Is it blue? No, it's green. It doesn't care about politics. So if you want to look at the history of Democrats or Republicans, going back to like 1928. Democrats have had a higher under this policy, under their control. When a Democrat has been in the office, they've had a higher rate of return than Republicans on average. But
the broad stock, you're talking about the broad stock market, right? I mean, stock market, regardless of what you think, the reality is under a Democratic, and I would imagine a Republican would say that's because of all the policies that were put in place before the Democrats took over, and the Democrats would say this is the wise policies they put in place while they were in power, and the Republicans screwed it up afterwards. But the reality is it's not that great, but the markets have moved up slightly higher while Democrats have controlled the White House than what Republicans since 1920.
Yeah, that's absolutely right.
How much?
Yeah.
What is it statistically?
Since 1928, 13% to 6%. So it's a decent spread. But here's the thing. The presidential policy matters, but it doesn't matter as much as the economy. Part of the reason the Republicans is lower, the return is lower, is because of Bush 2. I cannot blame the NASDAQ bubble crashing in 2000 on President Bush taking office then. I mean, so we're going to attribute the NASDAQ crash to Bush, even though he just took office right then. I mean, he had nothing to do with it. But yet, if we're going to look at these averages in a pretty elementary way, that's what it would tell you. Like, oh, it's Bush's fault. Well, it's clearly not, right? So presidential policy matters, but it doesn't matter as much as the economy. That's what really matters more.
So would you say that monetary policy matters a lot more than the Federal Reserve monetary policy, and the banking system monetary policy matters actually much more than who the president or who owns the House or Senate?
Absolutely. So, Pat, to your point, when you look at what the president can do, they can't really do too much without support of Congress. The Federal Reserve, Chair Powell, they can do a lot. And what they're doing right now, they don't need approval from any quote unquote bipartisan committee or anything like that. They just do what they want. Right now, they're flooding the economy with money. We have rates near zero. They're not going anywhere for years. That's going to be very positive for stocks when we look at future returns. This amount of liquidity out there, this easy policy to encourage lending and help juice the economy, that's a very positive for the stock market.
And how long can this continue?
Well, if you go back since 2008, roughly, I don't know how many times people have told me the Fed's out of ammunition. They can't do anything more. Guess what? The Fed's a pretty creative group of people. I don't think they messed up and didn't quite handle too many things more right along the way. But they've been doing a pretty good job here over the past couple of years, and especially in relation to trying to help the economy during this COVID pandemic. So how much more can they do? Yes, rates are at zero. I doubt they go to the negative rate environment like we've seen over in much of Europe. But they can keep flooding the economy with money with what they call quantitative easing, which is basically just buying up a bunch of bonds to get money into the system and keep long-term rates low, just to encourage bank lending also along the way. They can loosen some regulatory standards here and there. So there's a lot they can do. They can create new loan programs. What they're doing right now, they're going out buying corporate bonds.
Yeah,
they're in the market. They're buying corporate bond exchange traded funds or ETFs, which is crazy to think about.
Which is essentially the government, which is taxpayers
are buying debt from major corporations.
Are loaning money to corporations.
Yeah, including high-yield bonds, correct?
Yeah, technically they had to be investment grade at the time the program started, but they didn't care if they fell into high yield. And when the program started, you had a lot of big names that were considered safe bonds, and then they fell into high yield or junk bond status. So that was very intentional. They knew that was coming, and they were able to just date things accordingly. So yes, they're in the high yield bond market, and they're actually, they're out there buying the funds that own these things in order to keep what we call liquidity going. So there's the buying and selling of bonds happens pretty seamlessly, and you have banks lending to each other. Because the last thing we want is something like we saw in 2008, where liquidity dried up and banks weren't lending to each other.
The money market shut up.
Money market shut down. We were all afraid our banks weren't going to be open the next day.
That's right.
That's the last thing they want.
But doesn't this cloud or obfuscate the visibility in the real economy by the Fed stepping in there and supporting the bond markets in this manner?
Unless they are the real economy.
Well, that's a good point. I would say it really doesn't. I mean, we know what the real economy is doing. It's terrible right now. We're coming off of a shutdown. We still have almost 11 million people unemployed compared to where we were in February. We're nowhere close to our manufacturing output. Does it maybe make it a little bit harder to see what the true picture is? Sure. Does it help? I mean, but that's what the Fed does. They're trying to support the economy. Their job is policy to support the economy. If they didn't cloud it, there would be no Fed. And in that situation, then things would be a lot worse because we don't have anybody stepping in to lift the economy, to support things. Because, yes, Congress would be great if we could pass some sort of fiscal stimulus to help these people. But as you know, that's a little bit of a roadblock right now.
So I think what's amazing to me is how, first of all, in March we saw this downdraft, which was kind of expected considering when the lockdowns first started happening, there was still a lot of unknowns about the coronavirus and how lethal it was, et cetera.
And lack of therapeutics at the time.
Yes, correct. Didn't even know how to treat people well, right? And so the markets took a big hit, which is kind of expected at the time. Economies are shutting down. Then we started having a little more clear pictures, like it's only certain parts of the economy are shut down. We can actually figure out a way to keep a lot of the economy still open. But it seems it's remarkable to me how much the markets have rallied and really continue to rally. Last week was the week before last or whatever that ended a week ago was not a great week for the markets. But then it turned out that this week has been an extremely positive week for the overall stock markets. Are you surprised how well the stock markets held up and recovered? And
is it a lack of alternatives that's driving the capital into the equity markets?
Yeah, there certainly is. That the acronym for that, Pat, is TINA, right? There is no alternative. So you got to put your money somewhere. Bonds are giving you zero. So where are you going to put it? Stock seems to be a good option.
Tesla options.
Yeah.
What are you, 23?
There's a lot of that stuff going on, though.
Yeah.
And when we think back to March and February, from February 19th to March 23rd, that was the quickest drop ever from record highs into a bear market where we lost just about 30% on the S&P 500, which is a large cap blend stocks. And then what did we see? You see people start to panic, like, oh, I'm going to go to cash. And that's obviously the exact wrong thing to do, because what happened? So you saw the quickest drop ever. Then you saw the quickest recovery ever out of a bear market. In just about 6 months until the middle of August, we hit new record highs in the middle of August. So many people panicked. And if you listened to your emotions and fear took over, well, then you missed out on one of the strongest rally ever off of a bear market low. So that just kind of shows you, don't try to time the market. Have a disciplined plan and stick to it. So am I surprised by it? Trying to predict and market time things, it's an impossible game. The people who tell you that, now's the time to get in or out, they're trying to sell you something, and it's probably not going to work out too well for you in the long run.
So, Andy, as Chief Investment Officer, why don't you explain briefly kind of our philosophy on investments, about rebalancing, the discipline behind that? And what Andy's going to describe is not necessarily unique to Allworth. I think it's kind of, not all firms do it this way. But
those that are disciplined in their investment approach, I would hope most of them follow this.
Yeah.
Yeah. So what we do, it is disciplined. We have a process that we follow. I mean, we've all heard the mantra, buy low, sell high. That's exactly what we're doing, but we're not relying on our intuition of when stock prices are low or bond prices are high or vice versa or whatever. What we look at is where our money and portfolios that we have invested for our clients, where they actually are. So say, for example, we have a client who is in a 60-40 portfolio, 60% stocks, 40% bonds. We will look at that on a very regular basis. We don't look at it every day because there's a lot of studies that show you don't want to check it every single day, but on a very frequent basis, about every other week or so, we will look to see where the stock bond allocation is. If it gets up to 65-35, so if it goes from a 60-40 stock bond to 65-35,
which would happen when stock prices rise, correct?
Yes, when stock prices rise at a much quicker clip than what bond prices would rise, because they can move together. I mean, if stock prices go up a little bit, bond prices go up a little bit, that 60-40 is basically going to stay at 60-40. But when stock prices rise at a much bigger, quicker clip than bond prices, you're going to see that deviation. So things start to get a little bit out of whack. And what we'll do is then we're going to go ahead and rebalance and bring it back down to 60-40. Now, should it fall to approximately 55 stocks, 45, so about another 5%
Andy,
difference there.
Andy, so when it gets to 65-35, our discipline process says it is time to rebalance, and we will sell the stock portion of the portfolio, the equities, to bring the portfolio back to a 60-40. So we have essentially been selling the thing that has been doing the best and buying the thing that has been doing the second best, correct?
Correct.
Okay.
Or the worst, because you're looking at two things when a typical portfolio might have a dozen or 14.
Correct. Okay. Then so that's why we bring it back into rebalance, because it's risk. We're worried about risk, right?
That's exactly right. So when people go into a portfolio, it's based on their financial plan, how much risk they're willing to take, how much risk do they need to take, and maybe the advisor and client determine that it's 60-40 for whatever reason. That means we don't want to let it keep running forever and ever, because all of a sudden that person is exposed to more risk than what they're comfortable with. So you got to make sure that the risk that people are comfortable taking, that's what we're giving them, and that's what we're doing. So if it gets up too high, we'll rebalance. If it gets too low, if stocks drop more than what bonds might do, it could be 55-45. Then we're going to buy stocks to bring it back up. So essentially, we're buying low and selling high. That's the whole premise behind this.
Now, just with the caveat, every situation is unique. Not every client's accounts are invested identically, and there's tax considerations on some accounts, and there's lots of other. But kind of on a broad scale, if you look back at 2020, when did Allworth do the major rebalances, and what were those moves?
So on average, when we look at it, by following our disciplined process, it ended up being actually extremely timely. Not that we're market, trying to read a crystal ball and predict where things are going to go. The first rebalance was on February 20th. That was one day after the market high of February 19th. So it turned out to be pretty good to trim our exposure to stocks a little bit back to neutral, back to our target, not underweighting, but just target.
We ended up selling some stocks a day after the high, not because someone was sitting around thinking, oh my gosh, the stock market's so high. It can't stay this high forever. We better sell. It was just because our bands that we had put in place prior to 2020 dictated to you and your team that this is the time to do that, right?
That's exactly right. And then we saw the stock market fall into the quickest bear market ever. And then on March 26th, which happened to be 3 days after the market bottom, we ended up buying equities back to neutral because the stock portion got underweight relative to its target. So again, just following the process that we already had in place. And that's a key point that you just mentioned there, Scott. When people look to, make portfolio adjustments or investment decisions, it's a really, really, really bad idea to just do it on the fly, and it's going to be driven by your emotions. What's a much better idea is to have a plan ahead of time, so you can be more what I call proactive rather than reactive. So we rebalanced 3 days after the market bottom, essentially buying what was, hurt, which was stock. So we brought it back to the target. And then we did another rebalance in the middle of June. And the market's been a little bit choppy since then, but essentially it got moved too fast, too quick. And that we brought us back down to neutral there.
Got it.
So and these were I don't know of any other period of time when we did rebalances so quickly in
such a short
37 calendar days, right?
Yeah. And so, Andy, when you think about that, I interact with a lot of other firms. Part of what I do at Allworth, and I interact with firms outside of Allworth, and they will tell me about their investment policy statement and their processes. And then the first question I ask them is, so what did you do this year? How did you follow those investment policies? And many of them said, well, this was different this time, so we didn't actually follow our investment policy statements in our rebalance.
I know, right?
And I respond, well, why did you have them in the first place? And they said, well, this was different because of the pandemic, so we didn't feel it was appropriate to follow. Well, every time is going to be a little bit different, but you have to have a discipline in place to manage those portfolios, or there's no sense in trying to control the risk at all, right? And remember, it's for the average investor, they want to talk about return. A good advisor wants to talk about risk because it's always risk-adjusted returns, not just returns, risk-adjusted returns.
Clearly. Well, Andy, it's always good having you on the program. And
happy to have joined.
Thanks for taking some time, and glad to have you at the helm there too. And the discipline. It's nice that our chief investment officer doesn't get emotional and like, we're scared about this, because I feel that way at times.
Yes.
Right.
Come to think of it,
we have a fiduciary responsibility to lots of retirees. It's an important deal. So anyway, thank you, Andy.
You're welcome.
All right, we're just about wrapping up time here. I just want to kind of remind you, most of our listeners listen to this program on demand via podcast. If you're listening to this, you think, I've got a friend that could benefit from this. Maybe it's even just that clip that Andy was just talking about. Just send them the link to this. It's super easy, right? I mean, Pat, I know you did a few days ago. Send me the link to a podcast.
Not our own podcast, by the way. I didn't send a link to our own.
You are particularly good. You'll send, but forward it on, and while you're there, do a little review for us as well. We'd appreciate that. Anyway, we are out of time. It's great being here with you. We will be back this same place next week. Enjoy the rest of your weekend. This has been Allworth's Money Matters with Scott Hansen and Pat McClain.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.